Macaulay Culkin's reaction should be how investors feel about their portfolios lately. Good morning, everybody. It's 5:30 in New York. It is December 20th. I'm Lauren Simonetti.
Morning after. Yeah, good morning. I'm Cheryl Casoni. It is the morning after, folks. Well, you were under a rock yesterday. Here's what you missed. The Federal Reserve hiked interest rates for the fourth time for the year, and that is now raising the question, is the Fed sending stocks into a bear market? Is there blame to be placed? Let's bring in Francis Newton Stacy, Optimal Capital Director of Strategy, and Edward Stringham. He's president of the American Institute for Economic Research. Hey, guys, good morning.
Good morning.
All right.
Good morning.
Francis, let's start with, look, we saw the political pressure from President Trump on Jay Powell to leave rates alone. He not only doesn't really seem to care what the president says, he doesn't care what the market says as far as what he thinks where rates should be. What'd you make of the decision?
No, that's so true. And I think there was a little bit of posturing, maybe possibly yesterday, because they could have so easily come out and said, look, we're going to hike rates today. We're going to be data dependent next year. And the markets would have absolutely loved it if you looked at the trading before the decision. However, he said they're really only removing one rate hike. And when you look at asset classes worldwide, they're already mostly in a bear market. Up to 90% of asset classes are in a bear market, which means down 20% plus. And so that's been happening slowly over the last year. I think Lauren said that 298 stocks in the S&P are down this morning. So that's not a light situation. We're already feeling the tightening, and he's kind of being relentless.
Edward, you got to wonder here if market participants have turned into screaming little children who aren't getting their milk at night with their cookies, and they're having temper tantrums because they love easy money. They love QE. And the Fed is like, we are tightening. And they actually are saying we are steady on the path of tightening, and we're going to continue to sell off our portfolio. And the markets seem to be really annoyed by all of that. I mean, do the markets need to kind of calm down about this?
I was talking with my neighbor, and he said, we're beyond the point of no return. We have no plan. We just need to give up right now. I think that there's just this tendency among certain people to be calling the sky is falling. If we look at the monetary policy over the last 10 years especially, has been very loose, expansionary, and the idea that they're finally letting their foot off, taking the pedal, foot off the metal to the pedal. I think it's fine. I think the fact that people are overreacting to this, it's a little bit comical to me.
Yeah, no. I mean, look, Francis, 11 of the 17 officials said that they are comfortable with 2 rate hikes in 2019. Look, they had telegraphed 3 to 4 prior, so this is even better news, you would think, for the market. Still, you had that wild ride yesterday.
It's so true. I mean, I disagree with that a little bit, as much as I like you, Ed. The thing is that it's a mechanical thing, right? And they're saying that we're still well below normal, but we're not considering the amount of money in the system. Quantitative easing made asset prices go straight up. We saw that. Quantitative tightening is a reverse of that. Plus, you have to consider the fact that they are letting the balance sheet run off on autopilot. They're not adjusting that at all. So that's $600 billion coming out of circulation next year, which some guesstimate to be around 3 additional rate hikes into the rate hikes that they announced yesterday. So is the sky falling? We have a record amount of debt in the system. We have $9 trillion outstanding in corporate bonds. We have subprime auto, we have student loans, and this is really going to put pressure on the debt system, and it's really going to test the stability brought by quantitative easing. So I think it is serious.
Still, though, he seemed to really ignore the market reaction, Edward. And really quick about the bond market, especially that flow we saw into treasuries yesterday as people are going for safety. Those could have that could put economic pressures on the U.S. into next year. All the action we saw in the bond market, that does affect the average American.
Oh, sure, yeah. And Francis and I are actually friends, so she and I do agree on this one issue. The Federal Reserve can be tremendously destabilizing. Its policies can actually have ripple effects that cannot be predicted ahead of time. And so we can see decisions being made now which are going to flow into the economy in the future. And the fact that everybody always has to be watching them, to be guessing what they're doing, I think is a major problem. It's going to always has the potential for major fluctuations.
Well, it used to be like that under Greenspan back in the day. So here we go again. Francis, Edward, guys, thank you very much. Love the color commentary this morning.
Thank you.
Thanks, Cheryl.